Welcome back. Today, we are diving deep into one of the most polarizing stories in the semiconductor space. We are talking about Intel, specifically the massive buzz surrounding their 18AP node, which officially entered risk production on June 16, 2026. Along with this milestone, rumors have intensified about a potential foundry partnership with Apple. For investors, this sounds like the ultimate turnaround story. But is it a genuine opportunity, or are we looking at a classic market trap?
It is the defining question for Intel right now. For years, the market has been highly skeptical of Intel's ability to transition into a world-class foundry that can compete with the likes of TSMC. Entering risk production for the 18AP node is what many analysts are calling a proof of life. It proves that the technical roadmap is real, not just a set of promotional slides. However, we have to distinguish between risk production and high-volume, high-yield manufacturing. Proving you can make a chip in a controlled environment is one thing. Manufacturing millions of them with consistent quality is a completely different challenge. That is the ultimate test. Intel must pass to win over a client as demanding as Apple.
Let us unpack this potential Apple partnership. Apple has had an incredibly tight, exclusive relationship with TSMC for its flagship silicon. Why would they even consider Intel's Chai Foundry services? Is this a sign of trouble at TSMC, or is there a broader strategic play happening here?
It is all about geopolitical and capacity hedging. Apple is not looking to replace TSMC. TSMC remains the undisputed leader, currently moving toward their cutting-edge N2 node. Instead, Apple is looking for a secondary supplier to mitigate risks. If you look at the technical specifications, Intel's 18AP node is highly competitive with TSMC's N3P node. This technical parity makes a secondary supplier relationship viable. However, because of the operational gap between Intel and TSMC, Apple is highly unlikely to trust Intel with their flagship A-series or M-series processors anytime soon. Instead, they would look at secondary or peripheral chips, such as power management or connectivity components. It allows Apple to diversify its supply chain without risking its core product lines.
That makes perfect sense. It is a low-risk way for Apple to test the waters. A pilot program to see if Intel can actually deliver. But when we look at the stock price, it seems the market might be getting ahead of itself. Intel has surged over 200% year to date. That is a massive rally. It feels like the market has already priced in a flawless execution of this foundry strategy.
That is the primary risk right now, the priced-in trap. The turnaround narrative has become the consensus, leaving very little margin of safety. If we look at the strategic analysis from the US Stock Picker podcast channel, they use a dimensional scoring system that highlights this divergence. They rate Intel's technicals at 85 out of 100, reflecting the strong breakout and high trading volume. Sentiment is also high at 75 out of 100, but the fundamentals tell a very different story, scoring just 45 out of 100. This low fundamental score is driven by negative operating margins and extremely high capital expenditures. Intel is spending astronomical amounts of money to build out these fabs, and that capital intensity is a heavy drag on their financials.
Let us look closer at those moving averages, because they really highlight how extended this rally is. The 50-day simple moving average is currently sitting at $99.92. And the 200-day moving average is all the way down at $54.96. With the stock trading around $120, it is trading way above its historical averages. That suggests a lot of future growth is already being pulled forward.
That is exactly why the technical score is so high, but also why it is a double-edged sword. When a stock is trading that far above its 50-day and 200-day moving averages, any negative news can trigger a violent reversion to the mean. The volume data from mid-June is telling. On June 15th, we saw 134.5 million shares traded. On June 16th, it was 133 million. That is massive institutional volume. It shows that the market was highly active around the risk production announcement, but on June 17th, the volume dropped to 32.4 million shares. This drop in volume during the consolidation around $120 suggests that the initial frenzy has passed, and the market is taking a breath to evaluate the actual fundamentals.
And those fundamentals, as you mentioned, scored a 45 out of 100. Let us talk about the capital intensity. Building these leading-edge fabs is incredibly expensive. We are talking about tens of billions of dollars. Intel has to fund this while their current operating margins are under pressure. How does that affect their ability to scale the 18AP node?
It is a massive financial drag. Unlike fabless chip makers who just design chips and let TSMC handle the manufacturing, Intel has to carry the massive capital expenditures of building and maintaining the physical factories. If they do not secure high-volume customers quickly, those empty fabs become incredibly expensive liabilities. That is why the Apple deal is so critical. Intel needs a high-volume customer to fill that fab capacity and start generating cash flow to offset the capital expenditures. Without a Tier 1 customer, the operating margins will remain depressed, and the free cash flow will stay negative.
So, the technical success of the 18AP node is step 1. But step 2 is securing the customer to actually fill the fab. And as you noted, the probability of securing a flagship Apple deal in the next 6 months is low because Apple's supply chain is notoriously risk-averse. They will not risk their main product lines on an unproven manufacturing process.
Exactly. Apple is highly conservative when it comes to supply chain disruptions. They will want to see Intel run risk production, transition to high-volume production, and maintain stable yields for several quarters before they even consider moving peripheral chips over. A medium-term deal for secondary chips in the next 6 to 18 months is the realistic best-case scenario. It acts as a pilot program. If Intel performs well there, then we can talk about a larger, long-term partnership for flagship chips in 18 months or more. But that is a long horizon for investors who are buying the stock at today's inflated prices.
So, for our listeners who are looking to navigate this volatility, what is the game plan? Let us walk through a comprehensive investment strategy, starting with the overall market sentiment and fundamental analysis.
To summarize the big picture, the news sentiment is cautiously optimistic. The technical milestone of entering risk production is a major win, but skepticism remains regarding the operational gap with TSMC. Fundamentally, the strategy is high risk due to negative margins and massive capex. Investors must monitor upcoming quarterly reports for official yield data and, crucially, free cash flow. A transition to positive free cash flow will be the definitive signal that the Foundry business is sustainable.
And if someone is looking at this as a swing trade, what are the key levels they need to watch?
For a swing trade, you want to avoid chasing the stock above $125. Instead, focus on accumulating on weakness within the entry zone of $116 to $119. This aligns your entry with the support floor established on June 16th. To manage your risk, place a strict stop loss at $107.50. This level sits just below the recent low and protects your capital if the stock breaks down. If the trade goes your way, your first target is $132.50, testing the recent high. If we get a formal announcement of an Apple deal, that is the catalyst that could drive a breakout toward our second target of $145.
That is a very precise setup for swing traders. But what about long-term investors who want to build a position? When is the best time to start investing, and at what price point should they buy?
The recommendation for long-term investors is to hold or accumulate on weakness. Do not chase the current momentum at $120. The current valuation leaves no room for operational errors. Instead, wait for a pullback to the key support level of $105 to $110 to start investing. Entering at this price point provides a much stronger margin of safety and a far more favorable risk-reward profile.
And for those who already hold Intel and have enjoyed this massive run-up, when should they consider leaving the market? And at what price points should they take action to mitigate their risk?
If you are currently holding the stock, you should consider taking partial profits if the price tests the resistance zone between $135 and $140. That allows you to lock in significant gains while keeping a portion of your position active for any long-term upside. Now, to mitigate risk, you must have a clear exit plan. You should leave the market if the bullish thesis is invalidated. Specifically, if yield reports show the 18 AP node is failing to hit the 65% target, or if we reach the end of 2026 without a Tier 1 customer announcement. Under those conditions, you should exit the stock, as it is highly likely to revert to the $80 to $90 range. Additionally, keep an eye on macroeconomic headwinds. Any broad contraction in semiconductor demand would hit Intel's high-cost Foundry build-out disproportionately.
This is a textbook show me story. The technical foundations are being laid, but the financial execution is what will decide the ultimate fate of this turnaround. It requires patience and discipline from investors.
Exactly. In a market where a stock has run up over 200%, patience is your greatest asset. Let the market come to you rather than chasing the headlines.
A perfect note to end on. Thank you for this deep dive. To all our listeners, keep a close eye on the support levels, monitor those yield reports, and trade with discipline. We will see you in the next episode.
Clickbait video title: Is INTC the ultimate of the pop stocks? Intel 18 AP. Apple deal. Rumors exposed. Stock stop trade. Podcast growth. Stock picks with massive upside potential stocks and technology stock predictions.
Disclaimer: the information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We makes no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.